Today's webinar is entitled Precious Metals Investing Update, a 2016 mid-year update. I am joined by two notable authorities, Jerry Robinson, founder of Follow the Money, and also a technical analysis expert. He will be talking about charts for precious metals, and of course Tom Cloud, the fundamental analysis expert that we have on board, no stranger to Follow the Money, and he has spent decades in the industry and for sure is an authority. So we look forward to hearing from both of those gentlemen today. The topics for today, as mentioned, a technical and fundamental analysis of precious metals, then getting into a Trump or Clinton presidency and how that may affect precious metal prices, China's official gold reserves figure, and then moving to another country in East Asia, the Bank of Japan, and their plan for money printing. Then a look at Shari'a law and how a change that may be upcoming could have an impact on the gold market. More could be covered as well, so we thank you for tuning in, and we anticipate fielding your questions perhaps throughout the webinar, and surely at the end we will hear from Tom and from Jerry in that regard, so we look forward to your participation. So without further ado, let's bring on Jerry Robinson, the founder of Follow the Money. Jerry, perhaps you could share with us briefly a difference between technical analysis and fundamental analysis as you get the technical analysis started. Jerry, handing off the microphone to you. Thank you for joining us today.
Yeah, thank you, Justin, for that very kind introduction. I want to welcome all of our subscribers. Thank you for being here for our monthly webinar. As Justin mentioned, I will be talking about technical analysis, and don't be caught up in that name. If you're new to that, all we're saying is we're going to be looking at charts. Technical analysis is basically looking at the price and volume action on a particular asset. It's not really looking at the news. It's not really looking at any kind of commentary. Instead, it's just looking at raw data. We look at price and we look at volume. And we believe, going back for many, many years, even going back all the way to the very beginning of the 20th century, that many people, many traders, successfully traded simply based upon looking at price and volume. So that's what I have done over the years. I've used technical analysis to make money in the markets. And so today we'll be talking about gold, silver, and also the US dollar. And we'll talk about what we see in the charts. And then we're going to bring on Tom Cloud to fill in the gaps. Now that we know what the charts look like, what's driving the charts, what's causing the spike in volume, what's caused the new uptrend, and more importantly, perhaps for those who are watching, will the uptrend continue? That, of course, is a big, big question, and we'll talk about those things. So without further ado, let's just dive in and begin by taking a look at this very first chart here of gold. We called the new uptrend in gold back in the very first day of February. It was February 1st. As the breakout began to occur in gold, what we noticed was something that we hadn't seen in a while, and it was very big volume. And you can see volume right here that really began to ramp up as we began to pull out of this low that we had found right down near 1050 on gold. Well, when we see accelerating volume and accelerating price, we know that's something is going on there. It caught our attention and it tripped a new uptrend in our system, and so we encouraged you to know that gold had formed a new uptrend. All of our members were alerted at the beginning of February. That, of course, turned out to be a very good opportunity to get into gold at a very low price, well below $1,200, close to $1,125. 1150, somewhere in that range. Later in March, we noticed that a new long-term uptrend had formed, and so we alerted you to that on the 4th of March. And since that time, we've seen gold rise another 5 or 6% from that time. But since that time, we have run into an area of resistance here at 1350 to 1375, and this is not unusual. This is not surprising. This is the same area that we have experienced problems with in the past, going back to 2013. So this is certainly 1350. Any of you who've been following gold for some time, you know that's a pretty psychologically important price. But the zone here, the resistance zone, seems to go all the way up to about 1375, and this is the area where we're having a problem. It doesn't mean that we won't be able to scale it. It just means in the near term, expect some turbulence in this area until we can break past it. We have seen some heavy selling over the last few weeks, although the selling has not been as epic or as large as the buying volume, indicating that we're still seeing net buying, which is a very strong indicator that we are likely to go higher from here. The uptrend looks fine. The recent pullback is likely an opportunity here. We would say that $1,300 support is very key. If we break below $1,300 support, it's not the end of the rally, it's not the end of the world. It just simply means that a very important support area has been breached, and it may become an area of resistance until it can be overcome. So, long story short, our subscribers were alerted to the uptrend in gold early on in the year, and it has turned out to be a very nice rally over the last couple of months. Shifting gears to silver, silver has another set of circumstances that we want to pay attention to. For quite some time, we had pointed out the 1850 level on silver, and let me go ahead and show you a bigger chart here that shows you more length of time. This is a 10-year chart going back to 2006. And you can see that 1390 became this massive area of support that we had noticed on silver going back for some time. It had been resistance here, support here, resistance here, support here, and it just on and on. And you can see how 1390, $14, something in here was very, very important on this chart. And so we watched this area, and we found that as the breakdown of silver occurred through the 1850 level. This was the breakdown below 1850, which was the big support prior. We saw that silver fell all the way down to 1390, rebounded back to 1850, came back down to 1390, and then finally pierced 1850 from below. And this was the first time that we had seen a breach of 1850 from below since the epic run that we saw back in 2010. So this meant a lot to us when we saw this, and it also occurred on bigger than normal volume. Bigger than normal volume indicating institutional inflows, big money coming in. You and I can only create so much volume on a chart because we're retail investors. We don't have mega millions to put in like hedge funds or institutional funds or whatever the case might be. So when you see epic volume or huge volume as something is rising, you know that is institutional money that is coming in. And institutional money is what we follow. When we say follow the money, we're talking about the big money, right? We're talking about the smart money. And the smart money is what we track. Well, you can see here that 1850 became a great area of resistance just before the big, massive rally. So that was a very important area just prior to the big breakout that we saw in 2010 for silver. Well, we've seen it again. We've seen a breach above 1850, and so now we are excited about the future of silver. But you can see just here in the near term, now let's do a closer in chart. This is a 2-year chart of silver. You can see that 1850 level, which had posed as an area of resistance back in the very beginning of 2015, we had another attempt at a breakout in 2015, but it failed right there at 1850. And after finally bottoming out down here at 1390 at the very end of 2016, things began to improve a little, and we began to get some good volume rising here. We ran into this 1550 area, which was a little bit of a tough spot, but we got good volume there to catapult us right past it. We got a pullback, which was an opportunity, a great opportunity here. And then, of course, you saw the next leg up here on big increasing volume. The sell-off has come on not as big volume, indicating that this rally still has lots of steam. But do note that the resistance area is around 2050. This is the area that we've had a little bit of a hard time breaking past. This is an area just like the 1350 to 1375 on gold. This is the area where we may expect some turbulence around. And until we break through this area, we might have a little bit of trading sideways action. But once we break out above 2050, we're likely going to continue higher, and that's going to be very exciting. So those are the key areas that we're watching on silver and on gold. Silver, we alerted you to a new position uptrend on February the 3rd. So all of our subscribers received a new position uptrend on silver back at around $15 at the beginning of February. Would have been a great time to get in. We called a new long-term uptrend on silver at around $16.75. That was on the 22nd of April, and that, of course, would have been another great opportunity to get in. Now, of course, we are well advanced into this uptrend, and we're only buying the big pullbacks now because we've already made our position. We've already got our position well laid in silver and in gold. And so as we ride this, we're going to look for pullbacks as opportunities to add. Let me show you another chart, and now we'll focus on the dollar, because remember, gold and silver trade against the U.S. dollar. The U.S. dollar is the counterbalance, so to speak, to gold and silver, and therefore, when the dollar goes up, you typically see pressure to the downside on gold and silver. When the dollar goes down, you tend to see upside pressure upon gold and silver. So looking here at a longer-term chart of the U.S. dollar, we have made good money with this chart over the years, and we've shared this chart with you. It's a very important chart on the U.S. dollar. You can see anytime that we get into the overbought area here on the dollar, we're usually going to get a nice pullback here as well as here and even here. Right now, we are not overbought. We are not oversold on the U.S. dollar. Right now, the world is nervous, and they're viewing the U.S. dollar as a hedge against a lot of uncertainty related to Brexit, related to ISIS, related to China and the turmoil that's going on there, and related to all the negative interest rate campaigns that we see going on around the world. So right now, the U.S. dollar is a beneficiary of some of this nervousness, but you know, fundamentally speaking, those of you in the audience, if you've listened to us for some time, you know that the fundamentals of the U.S. dollar are not enough to continue driving it higher over the long term, because there is simply too much debt, and there's just far too many other issues facing the dollar for it to be in a long-term uptrend forever, right? That is nonsense. We don't expect that from the U.S. dollar. Now, what we will tell you to do is pay close attention to the 100 level on the U.S. dollar index. This is an area where we tend to break down. Where we broke when we touched 100 on the U.S. dollar at the very end of 2015, and it began to pull back off of the 100 area, we told you this was going to lead to a bounce in gold. We did not know it was going to form a brand new uptrend in gold, but we knew gold was going to bounce because the dollar had got overbought here. And so we knew it was time. And sure enough, we did get an epic pullback in the U.S. dollar, providing us a very nice gain in gold and silver. And that's what you're looking at here. This pullback in the U.S. dollar has been the rally in gold, and silver. But notice that recently, after Brexit, we have been seeing the dollar and gold and silver all going up, right? Now, that's unsustainable. You don't typically see gold, silver, and the dollar all going up at the same time. It indicates that we are in an unusual time frame. So the dollar in an area right now where it's not necessarily bought on the charts, technically speaking. It's not oversold. It's just in a kind of trading range here, but it does have some resistance coming up, not too far away. For our purposes now, we continue to watch the U.S. dollar within this range. 93.50 to 100 is the area where it is trading. A breakout above this will be negative for gold. A breakout below this will be very positive for gold. And so we'll continue to watch the U.S. dollar. In the near term, those of you who trade the dollar or use it as a way to measure gold or whatever, you can see here that we do have very solid support right here near the 200-day moving average. If you throw a 200-day moving average onto the U.S. dollar chart, you'll find that it tends to obey that line pretty well. you'll see here that it acted as resistance there. It acted as support here. It acted as resistance here, where you had the nice rally here in the dollar in May. It ran up right to the 200-day and then just reversed course, came back and tried it again, and you can see that it failed right there, but then it broke out. And then, of course, it held the 200-day moving average. So the 200-day moving average now acting as strong support for the U.S. dollar. We're well above it now. That would be an area that I would be watching when it comes to the U.S. dollar. So there have been a lot of things that have happened, and I want to bring on Tom Cloud now and have him begin kind of moving into the fundamental side of what's really driving gold prices. What is causing the breakout? What is causing the uptrend? What's the fundamental driver here? We can look at charts. We can see that we have an uptrend, but what is causing it? Well, there are several things we're going to talk about today, and Tom Cloud is here with me, and I'm honored to have him. Hey, Tom, how are you?
I'm fine, Jerry. Great to be back on the show.
Yeah, great to have you here, and I know the people are very appreciative to hear your insights today as to what's going on with all of the background that you have and all the knowledge and all the connections that you have in the precious metals world. There's several things we want to talk about. We talked about these things off of the air prior to this. We really want to hit these things. The first one is what's happening in October with the SDR basket. Would you explain that to us and explain to our audience what this means and what's happening?
Yeah, Jerry, what happened is we had a false alarm in 2015 when China wanted to get special drawing rights as the fifth currency to join the IMF. And they had a false start, and then they had a delay because they weren't ready with all the assets. It's kind of like getting a financial statement. They have to come in and show the IMF their financial statement to get the special drawing rights, and they probably weren't quite ready because they were accumulating gold at a record rate. But now they've been approved for October the 1st. So sometime between today and October 1st, or September 15th, I've been told, is China will announce to the world their gold holdings. The last time they did that was 2009, and they had about 1,700 tons. We know they've been buying every month. We know they've imported a lot through Hong Kong, and we don't know how much they've mined and bought in China, since China is one of the two largest mining countries for gold. So let's take an example. If they come out, which is the number I see the most, and they say they have 4,000 or 5,000 tons, up from 1,700 tons 7 years ago, then you're going to see that's very positive for gold, but not to ignite it. It's positive in that it puts support under it, showing they have that much and they're accumulating it. But what happens, there are people I've known in Europe for over 30 years that are telling me it's going to be way more than 4,000 or 5,000 tons, and is going to be more than the United States supposedly has at 8,163 tons. If that happens, then we've got a problem, because the gold known to exist, and you've done a great job over the last few years of showing how little space all the gold that's ever been mined takes up under the Eiffel Tower or in an Olympic swimming pool. And then you realize all of a sudden that gold that the United States loaned out and leased and took income off of it, a lot of that gold is now being claimed in Hong Kong, where people hold up bricks and say, see the serial number? I have it. I own it. It's mine. And yet the United States still claims they own it. So what has happened, the company in China has paid the lease fee off and bought the gold, which is the option they have. Now, the U.S. gets the money back, but do they go out and buy the same amount of gold and put back in Fort Knox, or do they just use the money for something else? And what's been rumored since Bill Clinton was president, that a lot of the gold is gone because they wanted a legacy of a balanced budget, so this money came out of nowhere and balanced the budget. So nobody really knows, Jerry, about all these things. But what we do know is between now and October 1st, China will announce their gold reserves. And I've had people ask me, well, what happens if they say they have 4,000 or 5,000? Well, China still gets to join. They may be hiding 4,000 or 5,000 tons, not being ready to show that they own more than the U.S. because they're still mining and don't have all the reserves they want to potentially have a gold-backed currency in the next 2 or 3 years. So that's what we're talking about on the SDR basket, which is one of the 3 things we'll talk about today that our clients have to keep an eye on.
I would imagine that there are people out there who are, not familiar with SDRs. Let me explain them very briefly because they can get a little confusing, and they're intentionally named to not provoke any kind of fear. Because really what the SDR is, for those of you who are listening, is it's really a world currency. It's the IMF's liquidity tool. So the IMF, the International Monetary Fund, operates as kind of a world central bank right now, mainly for the purposes of the West and for the benefit of the West. But nonetheless, it operates that way. And the SDR was created as a de facto currency back in 1969 in response to the ongoing problems that were happening here in the United States. The United States was fighting a war in Vietnam. They had the Great Society spending. This is what led to the breakdown in 1971 of the U.S. dollar and the Bretton Woods situation. Well, the SDR was created in 1969 because they knew they didn't have enough gold. The United States didn't have enough gold to be able to back up all of the redemptions that were coming in. So France realized they had a pretty good deal. They knew the U.S. was printing money. They were in Vietnam. They knew how expensive it was to be dropping bombs on Vietnam, and they knew the U.S. was likely printing money. So France said, this is a great deal. Let's go redeem all of our dollars and get gold. And pretty soon the U.S. just shut that down, and everybody knows that story in 1971. But 1969 is when they introduced this SDR as a way to stave off some of the gold redemptions, and they tried to satiate other countries with the SDR. It's evolved over time, and every 5 years the IMF reviews this SDR basket and just checks the currencies within it. Sometimes it's had many, many currencies. At the very beginning, I think there were 14 currencies whenever the SDR began, but today there's just 4. But now 5, thanks to the latest edition of the Chinese renminbi. And so the main thing to remember here is that China is now going to be part of this SDR basket, which is made up of currencies. Currently, the U.S. dollar, the euro, the Japanese yen, and the pound sterling. So as individuals, you and I don't walk around with SDRs in our pocket. These are strictly used for governments, and they represent baskets of currencies that provide liquidity. And those SDRs can take several days, according to the IMF, to actually liquidate and convert into currencies themselves. But this is a big deal, isn't it, Tom? That the Chinese renminbi...
It really is. It's just an emergency liquidity fund, like you said, and it's a big deal because some of the problems we see out there today, and we don't need to get into those because we don't have time, but you could wipe it out. It's kind of like the FDIC when you see their latest financial statement, and they have like less than 0.5% of all the insurance funds to cover what they have insured, and the government is saying we'll never bail the banking system out. So it's kind of the same thing, like you said. It's exactly a good explanation. That you just always run the risk of the IMF going through that money and trying to be the police of the world. And I think most people probably know that the U.S. controls the voting right at the IMF, which has been a contention for years, but they dropped it down to 51%, but they still control it, basically.
Yeah, no doubt. And the inclusion of the Chinese renminbi in the SDR is a big deal because it's going to lead to a greater dependence upon the Chinese currency, by nations, and I would imagine it'll come at the expense, of course, to the U.S. dollar. So that's going to be a pretty big deal whenever it is finally added in October. So that's coming up, and that's really bizarre. I think we're living kind of through an anomaly. Just one final point on that is that here we are in the 21st century, and China is the number 2 economy in the world. Back in 1820, China was the largest economy in the world. Today, they're the second largest, and yet their currency is hardly used anywhere. The second largest economy in the world, and their currency is not quite out there. So I think we're living, very possibly, my opinion, I think we're living in an anomaly right now where the Chinese currency could really roar higher as more and more countries move to it, and especially if they back it with gold, as Tom, you and I have talked about before. Let's talk about the failure of Abenomics. Let's move over to Japan. Tom, tell us what's going on over in Japan and why it's important to gold.
Well, it's very important. We've got a country that's spent 26 years basically in almost zero growth and deflationary pressures. We've seen mortgages over there now up to 100 years, mortgages that will go through 3 generations to pay the house off. We've seen this kind of attitude, and all of a sudden, if you can picture in the latest elections back last month, they come up in 77 of the 78 seats go to what we would call the Democratic Party or the ones that want to come out and print the money. They're tired of being reserved because they're really gotten worried about their military and where they stand militarily in the world compared to U.S. and China and other countries, Russia building up. So the first thing they do is they get 77 out of 78 seats. Prime Minister Abe makes his first call to none other than Ben Bernanke, the helicopter king that did quantitative easing here. So Bernanke is now consultant to Japan, and they're going to be printing money like crazy, building up a military, trying to get some inflation going. They'd rather have inflation. And the great thing for us as gold holders is Tanaka Holdings, the largest retailer of gold in Japan, had their biggest month ever this month. They're 60% higher than they've ever been. And even though the party that's ruling is telling their citizens to own gold, it's a good thing because the stock and bond market has done nothing. And then the other thing they've done is they're talking about issuing this perpetual bond that they're going to pay 22 basis points on, compared to an investor walking to the bank and having to pay the bank, 1% to hold their money. This way, the government will pay them a 22 basis points interest rate, but the bond is perpetual. It doesn't have a daily market, and you have to have somebody to buy it. So they're coming up with all these things to create money, to create higher inflation, to build up their military, and they're encouraging their people to buy gold, and they're consulting with Bernanke to show them how to print money. So this is all gold for us in the gold business, because the negative interest rates were already helping the world gold market dramatically. People aren't willing to turn money over to a bank when they may never get it back. Not 99%, but I'm talking about zero if there is a world financial crisis. So we're going to follow this thing very closely, because the Japanese certainly hold the second most U.S. debt, and that is what has America worried about this, is if they have $1.2 trillion of our debt, and they start getting money for their perpetual bonds and start expending, then they're going to have to sell their bonds here to buy their own bonds that go into the kind of growth they want to do and to get their military built up. So this will put tremendous pressure on the U.S. dollar later this year and next year, and that's the reason those 93.5 and the 100 index on the dollar is so important. That's what I look at just about every day. We're in the middle of that right now, but it's always something we got to realize, because when it breaks below 93, some people are saying it's going to end up back at 72, where it was in 2000 when gold was $256. And we know historically that every time the U.S. dollar goes down 1%, gold average is going up 13%. So we've got some interesting days ahead, but that's what we're going to keep looking at on Japan and keeping our clients aware of what's going on.
Yeah, Japan, for those of you who have listened to our commentary in the past about markets and things, you may know that I'm not a fan of Japan. I do not like the Japanese market, even though, they are doing all of this excessive amount of money printing. Their currency is just continuing to climb. Their market is just continuing to go down, and they're just moving into negative interest rates. It's just a really, really bad scene. Negative interest rates too, I think people are still trying to figure out what the heck all that means. Negative interest rates are where you pay the bank to put money in the bank. And there's a couple of things to think about that. Some people say, well, I kind of like the idea of putting my money into a bank and them telling me up front, you're going to lose 50 basis points for the whole year by keeping it here. And some people who are so worried about the overall economy are saying, you know what? If you will guarantee me a loss of 50 basis points, I'd rather keep it there than in my mattress. And so from some perspectives, you have people who are saying, I'll take it because they're worried. But on the other hand, negative interest rates are contrary to sound financial wisdom because they tax thrift. They tax thrift. If you decide to save, that's going to be a tax. If you're going to invest, it's not going to be a very good thing. However, if you borrow or if you consume, then you're going to be in good place. And so again, it's almost as if, Tom, this is an act of desperation. These guys have gone all the way to the very edge. They've lowered rates all the way down to zero. It's not giving them the result they want. We saw the Fed appearing willing to introduce negative interest rates right here in the United States, as seen in the 2016 bank stress tests that we saw not too long ago, where they inspected the banking sector's ability to handle a short-term interest rate of negative 50 basis points. So they're already testing the banks to see if they can handle negative interest rates. And so it appears that we may right here be on the cusp of that. And that's only going to be good for gold, because if low interest rates are good for gold, lower interest rates would probably be even better, like negative, as we go forward. So I think the negative interest rates are kind of a new abnormal. Tom, I want to move into our next topic because we do want to get to several topics here. The next one is a very fascinating one that many people may not know about, but it's a little small change that could be occurring to Shari'a law and, more importantly, to Shari'a finance law that could change the whole face of gold investing. Talk to us about this.
Well, it's a developing story, really, Jerry. It's been broken here in the last 2 or 3 weeks of this, but these Muslims out there that live under Shari'a law, 1,600,000,000 of them, bigger than China, basically have not been able to, the way it was explained to me is they have been able to own something like an investment that make law. It's supposed to be more of your money is supposed to be more of something that is there to protect your family and live, but it's not a speculative type thing. So what has happened is Muslims have gained trouble in some banking sectors around the world, getting accounts and complying to law, or saying they can't put their money in there. So they started this thing. It's kind of like us changing the Constitution or the Bill of Rights, which certainly we have politicians that would like to do that. But this is what it is. It's just changing something that's been around for 500-600 years is the way it's been done. And now the World Gold Council and the accounting and auditing organization of the Islamic financial institutions are doing this. And it's amazing what this could mean to gold. I mean, this could be, you could wake up one day and gold could go up $500 an ounce, and there'd be such a shortage of physical gold worldwide, you'd have nothing. And we're going to continue to see the demand growing anyway with central banks who are jockeying for position for a future gold standard, and then all the things we talked about in Japan and China, and then of course what could happen here. But right now, this is a developing story, and I was asking a lawyer in the gold industry what he'd heard about it and the time on it, and he says he thinks we'll know within 4 to 6 months if it's going to go forward. So it may not be quite ready yet, but the Muslims that follow the Shari'a law are not going to do it until the whole thing is ratified and they feel comfortable they're not violating the law. So we're going to watch this one very close, because this is not like somebody tiptoeing in. If this thing has changed the standards for investing, you just hold on, because it's going to be there's nothing in the world they'd rather own than gold. That's the number one thing they want, and that's the reason this thing's being looked at. It's because they have said our law is outdated, we need some update, and most important one is that we can buy gold and have our assets portable, liquid anywhere in the world, and ready to travel. So, and whether we like it or not, we could profit from it on the price appreciation side.
That's an important point. And those of you who want to follow this story, obviously we'll keep you posted on upcoming precious metals market updates on the podcast, but you can also just follow along on the news. You can search World Gold Council and follow the World Gold Council on Google and look for stories related to this topic. There are already many stories out there that you can read, but if you want to stay up to date, you might just check back once a month. Just Google World Gold Council and then maybe Islam or Shari'a, and you'll be able to stay up with this story. Because when this happens, if this happens, it really could be a big, big thing for gold, physical gold owners. Let's move in now to something much more relevant to us right here in America, and that is Trump versus Clinton. Both of these individuals running for the presidency, the highest office in the land, and obviously we have questions as to what they might mean for gold. Let me briefly talk to you about what they might mean for the stock market, and then we'll get Tom's take on what they might mean for gold. From my perspective on Trump versus Clinton, what you can expect from a Clinton presidency is pretty much what you would expect from an Obama administration, Obama presidency. The problem with Clinton is that there is so much worry and concern about fraud with her. There is so much obvious about her that does not inspire confidence in the American people. People don't trust her. And you see the currency today of our monetary system is trust. It's faith. And so we have to have faith in the institutions for the whole shell game to continue. We have to have confidence in the people who are running the institutions, and we have to have confidence in the institutions themselves. This is why things like WikiLeaks and Ed Snowden, when he came out with the NSA leak, and then other things like what we just saw here with WikiLeaks and the DNC. I mean, huge explosion in the Democratic camp here with WikiLeaks, just dropping about 19,000 internal emails exposing how corrupt the Democratic National Committee really is. And no surprises there. I mean, nobody's surprised by that. But the thing is that the more that stuff gets out, the more that it erodes the faith and the trust that people have in those institutions that issue this currency, that issue this, that control this economy, that plan this economy, so to speak. And so it's important that the people have trust. With Trump, you have a guy who is extremely brash, he's extremely arrogant, and he makes no apologies for anything. And some people are inspired by that. And he does tend to inspire a confidence, whether that confidence is fake, whether that confidence is false, whether that confidence is right. That's not the point. It doesn't matter if the confidence is good to maintain a paper currency. It just matters that it exists. So you have to have confidence. So out of these two, from my perspective and from my vantage point, I believe that Trump causes a pretty big stock market rally, and he also causes people to feel strongly about their country again, more patriotic, stronger about the U.S. dollar, wanting to make things right, all of this. So I feel that there is going to be some sort of confidence that is restored under him, and it will be temporary. It won't last forever. They'll find out about 2 years in. All the people who are very pro-Trump will find out 2 years in or less that he is just a mere man and that he is going to make the same mistakes as any other man makes when he's trying to lead others. And so you will have a downfall eventually. But I think in the beginning it could spark a really big rally. And I also want to say that, and we mentioned this the other day, and I want to give this to you as well, our FTM insiders, is that Trump could also be very big for Russian stocks because Russia has been under a lot of pressure underneath Obama. Putin remains under pressure in a Clinton presidency, but Trump, not so much. Russian stocks are extremely cheap, and we believe that Trump could be good for Russia and Russian stocks. So that's our take on what it means for stock prices. What does Trump versus Clinton mean to you, Tom? When you look at these two, what do they speak to you about the gold price and silver price? What do you think happens?
Well, here's what's interesting. This is a kind of a wishy-washy answer, but I called three big wholesalers I've known for one I'm 31 years, one I'm about 15 years, one I'm about 10 years, and was asking what they think, it would do. And like you said, they think that the fundamentals that are going on that we've already talked about today are far, far, far more important than who's the president of the United States in the gold world, not in the stock. I agree with you on the stock world, but this is so far down the line that it's worth talking about, but on the other hand, it's not what's going to be the driver of the price. And having said that, I'm like you. I think if Clinton presidency will continue to see that the way it is, but if these leaks can't continue and they show that President Obama knew that Hillary did, there's very strong rumors out there that he told her in 2009 she couldn't do what she was doing, but she kept doing it. And if any of this is proven through the leaks, then certainly it's going to be a great thing for gold because it'll put people in chaos and the stock market will go straight down. You'll see people around the world liquidating it. But on the side of Trump going in, I do believe there'll be a stock market rally without question. And Americans may not be as interested in buying gold as they have been this year in the last 16 years. But price-wise, I don't think it'll be a big effect because I do think he will do some things to build the military up and continue to bring our deficit up higher. And like you said, he'll be given a time to take the deficit from $19.5 trillion to $22 trillion, and nobody will really care because the military will be getting built up, the VA will get stronger, tax rates will be cut. He'll go after ISIS. They're very expensive. So these things will happen, but it'll make the debt continue to go up, which will affect the dollar grossly later, to the negative later. So don't look for it to be that big a deal, either one of them, because the other three issues we've already talked about, but certainly could have a minor effect.
Very good. Okay, well, let's go ahead and take a look at a couple of other charts before we open things up to your questions. Here is an interesting image of a 6-year rally that went from 1971 all the way out to 1977. And you can see here how that rally actually formed. We see a nice breakout. And this, of course, many people no doubt thought, oh, is this over? Did I miss the rally? Well, not quite, because it pulls back and runs again. And then people probably here said, well, should I add or is it going to go back down? And I'm sure there were probably 50-50. There were probably people out there saying it's going to go up and it's going to go down, right? Whenever you're at these peaks, you just never know. Well, the pullback occurs and then we get another rally, right? And then people probably said, is this the peak? This must be the peak. This can't go any higher. And of course, it continued even higher all the way into 1975. Then we saw, of course, the pullback. Now, this is very reminiscent to something that we've seen right here. And you can see that the rally that we saw from 2001 all the way out to now, that should say 2001 to present, not 2011 to present. But anyway, the point is that from going out from this period here, we can see that we have had this very nice rally in gold. But we have also had this pullback that is now being followed by another uptrend. My point to you is that based upon our analysis and based upon what we see, we believe that we are getting ready to enter another major leg, and we actually have already entered the next major leg up in gold. You can see in 1970s, from 1972 out to 1980, you can see how that big rally that we had from 1972 out to about 1977 or 1975 was pretty big. But you can see it pulls back, and then that rally really goes crazy into 1980. So this was the final leg of that big rally of the 1980s. We believe that we're going to see something very similar to this with this next rally. We think that the big rally still awaits us on gold. And we've already provided you all of the evidence today, and there's many other things that we didn't have time to talk about that are going to drive gold higher. Don't forget that everything that you touch in this paper economy is not backed up by anything. And we're going to see slowly a reversion back to the mean of backing currencies with some sort of tangible asset. And gold is the obvious choice. And we already see that happening now with China as they move towards more of a gold-backed type of currency as they continue to talk about that. So that certainly could cause this 1350 to 1375 resistance zone to be completely surpassed. And we believe that we will see a much bigger upside to gold in the coming months and years, and we will take out the previous high that we hit back in 2011. Tom, that's our forecast. We believe that it's going to go well above the previous high on the next leg up. What about you?
Yeah, we think it's going to get, once it clears this 1350 hurdle, and then we get up and we'll have a 1475 hurdle. I mean, there's hurdles all along, just like you can look at the chart and see. But certainly one thing that no one talks about is the volume of money that's been created just in the United States alone. We've gone from 6 trillion M2 money supply under Obama to over 12 trillion money created out of thin air. We've seen the world debt recently hit 100 trillion when Obama took presidency in the world of the United States. The world had $56 trillion of sovereign debt, what a country owed, and now we've just hit 100 trillion, of which 19.5 trillion of it is the United States. We all know that if they doubled from 20 trillion to 40 trillion in the U.S. the next 8 years, like Obama did, doubled it, and the world debt went to 100 trillion, we all know that the place to go would have to come to a point where they started some kind of gold standard, probably driven by the Chinese and Russians as the most likely prospect to do it. So there's going to be a breakdown, Jerry, somewhere in there, and that's when you're going to see that way it's been going up steadily like that quit. You just see one large move up like over a 5-day period, $500, $600, $700, and you can't buy it. I mean, there could be a time, according to my wholesalers, that right now some things are hard to supply. So we're just in a good, calm time right now to look at all these issues and weigh them. You still have the end of the Shemitah coming, and end of September. We're still hearing that could still be a small factor for gold and silver, but I think we're going through 2000 sometime next year. I mean, to me, it's got to get there just to have a reasonable price, and certainly Japan and the the new place in Beijing that sells physical gold and silver being available to two large countries like that is going to do nothing but take physical metal off the market. So I say $2,000 an ounce. I think we'll see for the end of 2017, no matter who's president.
Yeah, very interesting. Very, very interesting. Well, as we kind of begin to wrap this up, I do want to make your information, Tom, available to those who are listening, and just talk briefly about the types of services that you can provide based upon the information that we've talked about here. First of all, you can certainly add physical gold to your individual retirement account. Tom can help you with that as well. And let's talk about each of these individually, but let's also talk about one more thing that people can do is they can create their own physically backed gold ETF. Let's start with the IRA, Tom, and just talk about these real briefly.
It's real simple. There's two custodians that we recommend out of the 15 available. So they would go to equityinstitutional.com or goldstartrustcompany.com and just hit the self-directed precious metals IRA button, fill out the paperwork, send it in, and that's how easy. There's a section they'll ask who your broker is, and Kathleen here would mail our customer the information to put in for us as the broker, and then the transfer form. So you have an application and a transfer form, and then when the asset is transferred from where it is now, you just have to be sure it's in cash, because equity or Gold Star cannot take stocks and bonds. They can only take the cash that you would liquidate and send over. And then we would have a conference call and decide what percentage gold and silver you wanted and which products you wanted that were qualified to go into an IRA. So that was pretty simple, Jerry. That's just, they can see my 800 number up there, and they can call us at that. And the same thing on the next slide is this has been the most unbelievable thing. We saw the best June we've ever had in 40 years in business because of this. And basically what it is, if you buy an ETF and you get no gold, you get paper gold, and the only way you can get real gold is to buy a 400-ounce commercial bar over $530,000. So the little guy can only buy a piece of paper that's betting on gold to go up, and worse than that, if it's silver, you pay 50 basis points a year on SLV, and GLD, you pay 40 basis points a year for storage when there's not really any gold or partial golds there, but most of it's paper. But you get charged every year in the ETF 50 basis points, and then Mr. Sprott came along and he set them up, and his are better prices. He set up his ETFs for 45 basis points for silver and 35 for gold, being 5 basis points cheaper than them. But once again, you don't have the gold. What I worked out with one of the 9 COMEX warehouses in the world, only 9 that have LBMA and COMEX approval and the approval by Lloyd's of London to be the insurance carrier because of this, is IDS, International Depository Services. We can email you their brochure and our brochure on this. All you got to do is email us or call our office and ask Dan or Kathleen or I or Carol, whoever who answers what you want, and we'll email you the 2 brochures. So our storage fee is 20 basis points a year, and we'll give you 6 months free rent to start with. And then you have gold and silver with your name segregated, and it's yours. It's gold and silver. It's not a piece of paper, and you can have it mailed to you anytime you want by paying the shipping charges. To get them there, we pay the shipping charges. When you buy the gold or silver, we pay to ship it through the Toronto, Canada branch or to the Wilmington, Delaware branch, and we can talk to you on the phone about the advantages of each one, but won't get into that now. So a lot of you aren't interested, but if you are interested, after you have, you should have some physical gold and silver at home for emergency, especially silver. If barter systems were to develop or banks were to close for a few days, you would need that. But after that, you get enough to cover 3 months of that, then you probably may want to store some of it at this incredible rate. So 20 basis points is only $20 per $10,000 a year after your 6 months free rent, or on $100,000, it's only $200. So let me say this: there's no one in the world that has this deal but me. Nobody. And it goes back to the owners of the warehouse being friends of mine for over 30 years and doing this for me. So that's the other thing, and it is segregated. It is yours. You can get it anytime you want it. So it is, in my the best program out there in the world right now for anybody wanting to store their gold and silver in the United States or out of the United States.
Very good. Justin, let's go ahead and head over to you now, and we'll see if there are any questions at all.
Tom, let's hear from you. I wanted to emphasize this. A question was raised. Do you require a minimum dollar amount for the precious metals IRA? Just so we're all clear on a minimum dollar amount.
I do not, but let me tell you, there's if you talk about $5,000, something like that, the reason is you have a recurring custodian fee. I think it's $85 a year. They send you an update every quarter on prices. When you get to 70.5, they tell you how much you have to take out. They provide the 1099-Bs when you do take a distribution from the IRA. And then you've got the storage fee. And the way the storage fee is done at DDSC, Delaware Depository Service Corporation, is $120 a year up to $100,000. And so you'd have about $200 of recurring fees. So if you look at that and you've only got $10,000 in your IRA, that's 2% a year. But if you have $50,000 in your IRA or $100,000, then it's a very small percentage. So that's what people need to look at. And when you go over $100,000, they charge you 0.6%. And I'm also working with IDS now, trying to get them to store our some IRAs, and we're making great progress. I will probably have a better deal for storage by the end of the year with IDS than the warehouse. IDS is approved to store IRAs now, in addition to being the only COMEX and one of 9 COMEX warehouses in the world. So anyway, that's kind of what I would say. It's a small shift. It may not be worth the fees may eat you up, but certainly if you're doing 20,000, 1% a year is not bad. So anything over 20, I feel very comfortable telling it's worth it. But we're in the most dangerous time for numerous reasons we've discussed today and reasons we haven't. But that's the way I would end it, by saying give us a call, and Dan and Kathleen and I will walk you through and help you answer the questions and talk to you about how much gold, how much silver, and then what kind of gold and what kind of silver. Because you do have choices in percentages you want in each, and then what kind of product do you want in each, and we'll help you with that. So just give us a call.
Again, as you see on your screen, you saw the number 800-247-2812. Again, 800-247-2812 to contact Tom Cloud. I have done that myself personally. I'm a client of his and am happy with him being my precious metals guy, a man with ample contacts and many decades of experience in this industry. Well, we want to thank you all again for tuning in to this monthly FTM Insider conference call. Tune in again to the last Wednesday of the month, next month, as we again have another FTM Insider monthly conference call We want to thank you all for tuning in today. Thank you, Jerry, for the compelling information you shared and also the compelling information from Tom. Thank you all for listening today, and we wish you all a good day.